Title: Trading in the Zone by Mark Douglas. What if the reason you lose money in trading isn't your strategy, but your mind? Most people believe that successful trading is about finding the perfect strategy. They search for the best indicators. They look for secret chart patterns. They buy expensive courses. They try new systems again and again. But according to Mark Douglas, the author of Trading in the Zone, this approach misses the real problem. The biggest challenge in trading is not strategy, it is psychology. The market is one of the few places where your biggest opponent is not another person. It is your own mind. Fear, greed, doubt, overconfidence, impatience. These emotions silently destroy more trading accounts than bad strategies ever could. And until a trader learns to control these emotions, consistent success becomes almost impossible. The trading paradox. One of the most confusing things about trading is that the market is unpredictable. No one knows exactly what will happen next. Not professional traders, not analysts, not financial institutions. Even the best traders in the world cannot predict the future with certainty. Yet many beginners believe they must be right on every trade. They believe success means predicting the market perfectly. This belief creates enormous pressure. When traders lose a trade, they feel like they failed. They start doubting themselves. They start doubting their strategy. And often, they begin chasing the market, trying to recover their losses quickly. This behavior leads to emotional decisions. And emotional decisions usually lead to bigger losses. Successful traders understand something different. They understand that trading is not about certainty. Trading is about probability. Thinking in probabilities, imagine flipping a coin. If a coin has a 60% chance of landing heads, it means heads will appear more often over time. But that does not mean every flip will be heads. You might flip tails 3 times in a row. You might even get tails 5 times in a row. Yet the probability has not changed. Trading works exactly the same way. A good trading strategy might win 60% of the time, but losses will still happen, sometimes several losses in a row. Professional traders accept this reality. They understand that individual trades do not matter. What matters is the long-term outcome over many trades. Amateur traders struggle with this concept. They expect every trade to work. When it doesn't, they react emotionally. This emotional reaction is one of the biggest reasons traders fail. 2 emotions dominate most trading decisions: fear and greed. Fear appears when traders are afraid to lose money. Imagine a trader who enters a profitable trade. The price begins to rise, but instead of letting the trade run, fear appears. The trader thinks, what if the market suddenly reverses? What if I lose my profit? Because of this fear, they close the trade too early. Later, the market continues moving upward. The trader realizes they missed a much larger opportunity. Now let's look at greed. Greed appears when traders want bigger profits. Imagine another trader who enters a trade that quickly becomes profitable. Instead of following their plan and taking profits at the target level, they hold the position longer. They believe the price will continue rising. But the market suddenly reverses. The trade that was profitable becomes a loss. Fear and greed constantly pull traders away from discipline. And discipline is the foundation of successful trading. The 5 fundamental truths of trading. Mark Douglas explains that every trader must accept 5 important truths. The first truth is that anything can happen in the market. No matter how strong a setup looks, unexpected events can always occur. The second truth is that you do not need to know what will happen next to make money. You only need a strategy that works over many trades. The third truth is that there is a random distribution between wins and losses. Even a profitable strategy will produce losing trades. The fourth truth is that an edge simply means a higher probability of one outcome over another. It does not guarantee success every time. The fifth truth is that every moment in the market is unique. Because of this, the market cannot be perfectly predicted. Once traders truly accept these truths, something powerful happens. They stop trying to control the market. Instead, they focus on controlling themselves. Successful traders follow rules. They define their risk before entering a trade. They accept losses calmly. They follow their trading plan consistently. Beginners often do the opposite. They change strategies frequently. They chase the market after losses. They take revenge trades. They risk too much money trying to recover quickly. Over time, this emotional behavior destroys trading accounts. Professional traders understand something important. Consistency in trading comes from discipline, and discipline comes from mindset. Without the right mindset, even the best strategy will fail. A real example. Imagine two traders using the same strategy. Both strategies have a 60% success rate. Trader A follows the plan exactly. They risk a small amount on each trade. They accept losses calmly. They stay consistent. Trader B behaves differently. After two losses, they become frustrated. They increase their position size to recover quickly. They ignore their stop loss. They close winning trades too early. Even though both traders started with the same strategy, their results become completely different. Trader A grows their account steadily. Trader B eventually loses their account. The difference was not strategy, it was psychology. Building the right mindset. To succeed in trading, you must train your mind. Accept uncertainty. Accept losses as a normal part of trading. Trust your strategy. Follow your rules consistently. And most importantly, detach your emotions from individual trades. Think of trading like running a business. Every business has expenses. Losses in trading are simply the cost of doing business. If you accept them calmly, they stop controlling your emotions. Over time, this mindset creates consistency, and consistency is what produces profits. Conclusion: the biggest secret in trading is not a strategy, it is mindset. The market rewards patience, discipline, and emotional control. Traders who think in probabilities survive. Traders who chase certainty eventually fail. So if you want to improve your trading results, remember this lesson from Trading in the Zone. Control your mind before trying to control the market. Because the most powerful trading edge is not an indicator, it is psychology.